Meet Kenith. He runs a flower shop on a very busy street. Business is good, but he'd like to do better. Kenith is smart. He notices that the business is really good on certain days like Valentine's Day. In fact, the business soars on certain holidays that demand outpaces supply. To get ahead of the problem, Kenith decided to increase his inventory. He asked his supplier to increase his daily inventory by 20%, hoping customers would come, but they don't. Lying there unsold, Ken's flowers withered away. Kenith took a hit in the next week. Kenith wondered, how do I accurately predict my future sales? Seeking better control over his inventory and sales, Kenith hired the services of a professional firm. The financial modelers analyzed Kenith's historical data, his sales receipts and balance sheets from the last 2 years. They did what-if analysis to account for various scenarios and events. They then built a predictive model that would take the guesswork out and help make better decisions based on forecasts and assumptions. A financial model is a mathematical model designed to represent a simplified version of performance of a financial asset or portfolio of a business, project, or any other investment. Based on the models, Kenith was accurately able to predict the demand and stock his inventory accordingly. Sales were up by a whopping 20%. Numbers at the heart of business decisions, and financial models help owners like Ken make better decisions.
As Einstein said, everything should be made as simple as possible, but not simpler. The job of a good financial model is to make the project or the company with complex functionalities look simple, easy to understand, and convenient to use for any decision-making purposes, but at the same time, not lose out on any underlying details. Even though financial models are crucial to business decision-making and planning, the vast majority of people work completely without any structure and guidelines regarding quality, methodology, or discipline when developing or reviewing models. This is true in large corporations as well as small businesses and results in huge business risks for owners, investors, and stakeholders. Properly formatting the Excel models is also important because it makes it easier for others to read and understand your analysis, and also for you to read and understand it if and when you change it later on. So this is the second session on the principles of well-designed spreadsheets. In part 1, we covered readability and transparency. So let's move on. Now that we've seen 2 of the 5 design principles, we'll move on to the 3 remaining design principles or golden rules of financial modeling, which are consistency, integrity, and simplicity. And we learn how these are applied when building financial models. Let's begin with one of the most important criteria for a good and sound financial model: consistency. Consistent formatting for cells of the same type makes the model look professional and adds validity to you and your business. How do you ensure consistency? First, across all worksheets, the same time period should be used in the same column. Keeping the time periods consistent and the formula constant across each row. It is not advisable to change a formula midway through the year, row, or column. It is also suggested to use consistent sign conventions. For instance, income, assets, and cash inflows are all positive items, while expenses, liabilities, and cash outflows are all negative. To ensure consistency, we need to maintain sheet structures, formulas, labeling, and formats across the model. Before starting with calculations, we must ensure the template has certain essential elements such as the timeline, period reference, the number of days in a year. Replicate these across the model and ensure uniform structures before beginning with calculations. Ensure that you use the same arrangement of data across sheets, especially in the order of which column carries which year's data. For instance, if column G carries the data for 2012, be it for the same number of years or when the number of years is different, keep to the format so that cross-sheet references can be made easily, and a mismatch of column letters clearly indicates a referencing error. If one sheet needs an additional column, it is worth adding an additional column in all the other sheets. Reduce the width of these spacer columns so that they do not affect the visual layout of the model too much. Consistency can be achieved mostly in terms of columns. Consistent row references across sheets are more difficult to adopt because sheets usually have different amounts of calculations requiring different number of rows. It is advisable to try to use the same formula across columns and write the formula in the first column containing the formulas and copy this across. Minimize the number of unique formulas by using the same formula across a row or down a column. Use Excel's go-to special function or shortcuts to find differences. Control and backslash locates the first different formula on the row, while Control plus Shift plus backslash locates the first different formula on the column. Where formulas are written to use the previous column's results, example for a growth formula, we may not want to put this in the first column since there is no prior year. However, the best way to represent it is to insert an additional blank column to the left of the first formula column, which can then serve as a prior and blank year. Keep the width of this blank column very small so the additional column does not change the look of the layout very much. In this way, we can use the same formula across the columns. Coming to consistent labeling and formats, variations in formatting in terms of font size and colors of the font and the background are ways to guide your users through the model's screens and informational content. Use the same font size and formatting, bold, italics, underlines to designate the same type of item. If you are using title casing in your labels, example each word begins with the uppercase letter, do so consistently in your labels, across your labels for added visual polish. If you are using colors in your fonts and cells, again be consistent throughout. Always use the same label for the same account. For example, calling it cash flow from operations on one sheet and cash flow from operating activities on another opens up room for confusion. Formatting of similar cells makes it easier to use them for further calculations as well as for the end user to understand the flow. Some accepted practices are to use a pale background to mark cells that hold input data. The color background means that you can see which cells are the input cells even when there are no entries in them. For instance, use a blue font against the pale yellow background to further differentiate these cells as the input cells. Use strong colors to mark cells that you need to review again, such as cells that you are making temporary changes on to test the spreadsheet. Color the background of these cells rather than just the fonts so that you can spot them even when you are quickly going through the model screens, and always remove the colors once the cells have been corrected. Another important consistency point is to show the unit labeling correctly. Example, currency value, quantity. This can lead to huge level of confusion and sometimes to errors as well if the units are not consistent across sheets. Hence, it is always suggested to have a column between the data labels and the data numbers and mention the units of all items there. This leads to a proper structure of the sheets and gives out all the required information to the user as well. Here's an example to make you understand it in a better way. So here you can see that the data labels are clearly defined in the column B. The values are in column D and their respective units are clearly labeled out in column C. Now, it's very important to note that you should refer to units and to labels in the same manner everywhere. So for example, here you have INR crore and here you've referred to it as rupees crore. This is definitely not good modeling best practice. So the ideal way is to pick one of the two and use it consistently. Now it could be that units would differ from item to item in a single sheet or even in a single table. This is why clear labeling is extremely important for the end user to understand. Moving on to consistent row headers. We'll move back to the timeline example that we saw in an earlier module that we covered. So when we discussed timing flags, we said that we'll set up these timings in one place and link to them across the model. Now it's important to use this consistent timeline everywhere. Again, moving to these three sheets where we have inputs, calculations and FS, you'll notice that the timelines have been populated on the inputs sheet and the calculations sheet and the FS sheet all refer to the same sheet. This ensures that the timeline is consistent across all the sheets in your model. Moving on to consistent row headers. Again, you need to follow consistency in doing this. Keep the same year in the same column across all the sheets. Show proper headers and formatting so that every subheading and sub-calculation is clearly separated out and outlined. As you can see in the example here, for revenue calculation, the quantity and the price or the rate are boxed out and the revenue is separate. So this makes it extremely readable and consistent across various sheets in the model. Having this kind of a modular structure definitely makes the model a lot more intelligible to the end user. We saw revenues. Similarly, we have costs, which are broken up into fixed costs and semi-variable costs and variable costs. Breaking it up into these kind of sections and giving proper headings makes the model extremely useful to the end user. Let's now look at the next principle of preparing a good and standard spreadsheet, which is integrity. Integrity refers to the quality of a spreadsheet where all the values of a particular item are same. Integrity is the quality which ensures that there are no errors present in the spreadsheet. To maintain integrity of the spreadsheet, a lot of steps are undertaken which involve checks, data validation and design. We will now discuss some of the most important and widely used techniques to maintain the integrity of the model. So far, you must have got an idea that one cannot simply guarantee that the spreadsheet will always work, but you can minimize risk with good design, data validation, protection, avoiding circular references, checks on high-risk calculations, and master checks. Let's begin with the 5 principles of good design. Before creating a spreadsheet, the developer should keep in mind the appropriate sequence and flow to go about it. This flow should be properly thought of so that the resultant design obtained after the specification process is a good one. A good design leads to a proper understanding of the model to the reader. The user should be able to adapt to the model easily. A good design will always possess integrity. An ideal design will have values which will be properly mentioned with zero discrepancy. The format of the spreadsheet would be properly segmented with consistent sheet structures, formulas, and labeling. Good design reduces the risk of undetected error. A clear model functionality comes from good formatting, good presentation, and good layout. When users can more easily understand a model, the risk of errors is reduced because that is the result of a proper flow of sequences and calculations from the modeling side, which automatically reduces the scope of any unwanted error in the model. A good design is developed keeping in mind a proper flow of things while creating the business model. Coming to data validation refers to the process of controlling allowable inputs. It is very important to have correct inputs for our calculations, and it is more important to not have any incorrect entries while we are building the model. For such checks, the data validation tool is extremely helpful. With data validation, you can make your data entries more foolproof by limiting the types of data that can be entered. The simplest limit may be the type of data. Example, allow only integers or values within a range. But you can also have it function with more sophistication, such as providing you with easy to build lists of the items that the worksheet can accept. Additionally, data validation, which is available under the data ribbon in Excel, also has pop-up boxes that alert you to the wrong type of data being input. You can use these pop-up boxes as the type of cell comment in their own right. The setting tabs under data validation is responsible for specifying the inputs. They can be of different types such as whole number, decimal, date, time, and list. The list option is used in cases where there is a requirement for drop-downs or when there is a similar calculation performed differently. After the settings tab, you can select the input message tab. With the checkbox for show input message when cell is checked, you can enter the message or information that appears when you put the cursor on this cell. You may want to have this function by itself in lieu of cell comments without the data filtering that we see on the settings tab. In this case, simply leave the allow entry on that tab to read any value. Finally, the error alert tab. To check for errors, select the error alert tab. If this is undefined, Excel will show a default error message after the invalid message is entered. This tab also has the setting for what to do if invalid data are entered. Under the style list box, you can choose to have the sequence stopped as shown or only have a warning or information icon show up. The stop option is the default and does not allow data outside the defined parameters to be entered. The other two allow data that are outside the defined parameters to be entered but will flash a message first. Let's take a look at an Excel example to understand this clearly. So here we've set up 4 examples to show you data validation. In the first example, we need to have a cell validated so that the input is always a percentage, and because it's a percentage, obviously it cannot be greater than 0. So data validation is here in the data ribbon under data tools, data validation. So here the validation criteria is to allow only decimals that are less than or equal to 1. This will ensure that you can never input a percentage value that's greater than 100%. There's no input message or an error alert here. Now if you do control 1, you'll further notice that this format has been set to percentage. So even the visual representation has been set so that the end user cannot meddle with it. Now here we did not have any input message or error alerts. Here we've also set up an input message which clearly says that no negative input can be allowed in this cell. So if you try to enter a negative number, you'll immediately get an error message which says negative input not allowed. This is again set through the data validation tab, where the settings have been set to allow only whole numbers that are greater than or equal to 0. So no negative numbers. There's an input message as well as an error alert. So the input message gives you a warning even before you enter the input, whereas an error alert gives you a warning or a cautionary notice after you have entered the input. Here we want the input to either be yes or no, and therefore there is a drop down. This has been done by using the list feature in the data validation tab, where you select list and give only 2 options. So nothing other than these 2 options can be input in the cell. Here we have an error alert which says input should either be a yes or a no. So if you try to enter anything else here, you'll get this error message. Similarly, the last example that we're going to see here is that the input can only be a date between 1st April 2014 and 31st March 2018. No sweat, because data validation helps you to clearly identify the inputs to be required in the cell. So here we have allowed dates between 1st April 14 and 31st March 18. You have an error alert which says only dates between these 2 dates are allowed. And therefore, if you try to enter anything else here, say 31st March 2014, you'll immediately get the error message. Typically, it is advisable that when you have an error alert as part of your data validation, it should clearly indicate the condition that is causing the error so that the user can rectify it, rather than simply saying erroneous input or wrong input or something to that effect. So in this way, you can use data validation to minimize erroneous inputs in your model. The next important aspect pertaining to integrity is protection of sheets and workbooks. Protection is basically protecting your document from any unwanted changes, or to keep it from users who can misuse the model, or from the users who are not supposed to be the affiliated end user of the model. This is done with the help of passwords and protecting the file data structures. To protect this data, you can either protect each worksheet or protect the structure of the sheets. Remember that protecting worksheets hampers navigation. We must protect each worksheet to limit user interactions to cell marked as input. Once you have a model ready, or if you want to share the under construction model, you need to be very careful, as even a small change could affect your model and lead to the failure of the model. To prevent this, you should protect your model. For protection of spreadsheet in Excel, you should go to the Review tab and select Protect Sheet. This enables the lock, which prevents change in history of changes done and prevents change in tracking of data. You can also add a password to the sheet if necessary. Moving on to protecting the structure of sheets. For the protection of the structure of your model from any unwanted changes in the rows or columns, you will once again go to the Review tab and select Protect Workbook. Once you protect your workbook, sheets can't be moved, deleted, hidden or unhidden or renamed, whereas new sheets can be inserted. You can also protect windows from being moved and repositioned, which keeps the window at the same place each time the spreadsheet is opened. The one disadvantage to this feature is that it can reduce the flexibility of the model and restrict the users too much sometimes. The downside is that protection disables the audit toolbar and navigation is more difficult. As we just mentioned, although the protection of sheets and workbooks help in preventing any unwanted error or calculation to creep in the model, it comes at the cost of easy navigation. It also disables the audit toolbar, so it becomes quite difficult to check the working of the calculations like tracing dependents, precedents, and evaluating formulas. Another thing to remember in modeling is to avoid using circular references. A circular reference could be a cell that references itself or a starting cell that references a string of other formulas, the last one of which references the starting cell. The circularity is referred to as a formula loop, and the starting point in modeling is don't use it. Circular references are to be avoided. That said, the one generally accepted use of circular reference is in the calculation of average interest for the excess cash, or revolver plugs for balancing a balance sheet. Let's understand this in a little more detail. Circular references are one of the most common nemesis of a good and consistent financial model. Circular references are references which are used across the spreadsheet which involve linking the input part of a formula which somewhere is backlinked to the output of the very same cell. At its simplest, a circular reference is a formula that references itself. There are many arguments against using circular references. If Excel is not set to use iterations and the model has iterations, Excel will hang. That is, it appears stuck on the screen. If there is an error, such as #div or #ref, it spreads uncontrollably throughout the model. Even if the source of the error is corrected, the error message is forever caught in the loop and the model remains inoperable. Getting this message out requires a cumbersome manual process of deleting a cell in the circular reference loop and then recreating it again. If iteration is on for a specific and known calculation, there is no way of detecting other unintended circular references put in by mistake, since the use of the iteration setting disables Excel's circular reference detection system. Let us understand better with the help of this example. We have C1, which is the sum of B1 and B2. Now B1 is the sum of A1 and A2, but as we can see, A1 is 5% of C1. These would create a never-ending loop and there will be errors as we cannot calculate this. Therefore, circular references should be avoided. Excel will show an alert if there is a circular reference. Enabling iterative calculations or the use of macros is advised to break the circularity loop. Unless you have to perform a specialized function, the use of circular references in your spreadsheet should be avoided. Moving over to high-risk calculations. High-risk calculations are those which involve use of complex formulas or arrays. These should be taken care of and should be checked multiple times before they lead to huge errors in the calculations which might make the model produce wrong results. Let us cover some key high-risk items where even small changes can lead to large errors in the model. These include functions with multiple arguments, changes in timelines, in this case cash flows can be tricky, foreign exchange conversions, pivot tables, and external links. We will look at each of these in a bit more detail. Functions with multiple arguments like offset, index, match, VLOOKUP, SUMIF, and SUMIFs are those which involve complex calculations with multiple arguments. Be very careful while using them as it can lead to big mistakes. Special care should also be taken while using the financial functions like XIRR and XNPV which require the use of timelines. Change in timelines can be tricky on cash flows. Sometimes a model is created for an annual timeline, but there might be some requirement which involves building the same for a quarterly timeline as well. In such a case, the change in timeline needs to be carefully performed as the timeline is linked to all the sheets and is same across the model. So any mistake in handling such calculations will lead to wrong calculations for the whole block. If the calculation is not for an entire year, we should use annualizing factors. These are very important while using ratios involving P&L and balance sheet items. The next high-risk item is foreign exchange conversions. Conversion which involves forex are very sensitive to the cell values. If we are using currency A and B, the place where currency A is used and the place where currency B is used should be clearly identified in the spreadsheet. Further clarity should be gained as to where A to B conversion rate is required and where B to A conversion rate is required. Pivot tables are created with a large amount of constituent data. So any change in one data value can cause a great impact on the output. So one should be very careful and diligent while working with pivot tables so that problems like new data not getting included when you refresh and grouping effects of one table on another table do not occur in the model. Finally, external links are links which are generally present inside the spreadsheet. These links are basically links to cells of other spreadsheets located at a different place. Now, if we are exporting a spreadsheet or using some value or formula from a different model or any other version of the same model, then we should keep in mind that these links, or else they will lead to errors. A very common instance in this case is the occurrence of href errors onto the screen if the source link sheet is unavailable. Finally, master checks are the biggest lifesavers for any modeler. It is always advised to keep putting multiple checks while building important calculations so that the scope for an error to creep in is minimized to the maximum. Further, all these individual checks should be linked to a master check at the start of the model. Master checks are added to keep a track of all the checks present throughout the spreadsheet. If there is an error anywhere in the model and there is a respective check at that particular segment, the master check will automatically highlight the error to the user, and the same can be resolved without wasting time to find the error in all the sheets. Checks are built in so that errors can be more easily detected. When working with a balance sheet, a parity check that checks that the two sides are balanced is an example of an easy and effective check. While building various components, it is advised to keep on making various checks to trap an error during the process of the calculation itself. Otherwise, once you are done with the calculation, it is very difficult to go and check each and every cell if any error is shown in the final outcome. Let's look at some examples of the most commonly used checks. Firstly, there should be a check to see if errors like href, hashdiv, name, etc. are not present in the model. Sometimes, while working with annual and quarterly calculations, it is very important to keep a check on vertical sums being equal to horizontal sums, like annual versus sum of months, business by country versus by product. Also, there should be a check to verify if the accounts which are not supposed to have negative values are not ending up in the negative. This would be an immediate red flag for the calculation done for the same or the linked cells. For example, property, plant and equipment after depreciation, outstanding debt after repayments, etc. And we have already discussed about the balance sheet check. We should establish a tolerance factor for the model and verify the differences of the required calculations with the tolerance factor. Let's look at an example to get a picture about the checks. So here we have set an error tolerance input of 0.01, which means any rounding difference that is more than 0.01 is not going to be accepted by our check. Here we've set up a total check, which is the sum of the following three checks, where we have a balance sheet check, a cash balance check and a percentage check. Let's see what these checks represent. Now the balance sheet check clearly checks for whether the assets and the liabilities match. Now you'll notice that we've used an abs function here. This ensures that whether the difference is positive or negative, the absolute value is considered and compared with your error tolerance. So whether the liabilities are greater or the assets are greater, it does not matter how you code your formula when you use an abs function. That is the benefit of using an abs function as part of your check formulas. Now this will be compared with the error tolerance, and if it is greater than the tolerance level, you'll get a 1. If not, then a 0. So the minute our assets are not equal to our liabilities, you'll get an error here. And immediately your total check reflects an error. Similarly, for the cash balance check, now in most operating businesses, it is always considered that cash can never be negative. The company or the entity will always have positive cash at the end of the year. So if there is negative cash, then there needs to be a red flag, because that is a pointer to the management of the company or the project that there is a shortfall that they need to provide for. Now here, this check simply compares the cash balance with 0. Now in this case, we are not using an error tolerance because basically we want to ensure that the cash is not negative. Now the Problem with using an error tolerance here is that it will reflect all values or accept all values that are greater than 0 but less than 0.01, which is something that we do not want to do, and hence the check has been coded directly by comparing the cash balance with 0. The last check that we have here is a percentage check to ensure that your inputs for the revenue split between 3 products is not greater than or less than 100%. It should exactly be 100%. So this check is directly coded here such that the total of the revenue split is always equal to 1. If it is not equal to 1, it will give you 1 as an error message. Now any of these errors will reflect in the total check. So typically you would have your revenue split in the inputs sheet, the balance sheet check in the financial statements sheet, and the cash check either in the calculations sheet or in the financial statements sheet where you have the cash flow statement. Having this master check reflect on the top of every sheet allows you to rectify any error as soon as it appears, because the total check immediately shows that there is an error in your model. Just to recap what we saw in the previous example, a total check was used for all the individual checks in the model. A master check is a check which is linked to all the checks present inside the spreadsheet. This check shows an error if there is even a single error present inside the spreadsheet. This check should be visible at the top of every sheet so that it is easier for the developer to cross-check the spreadsheet, and any one error message anywhere will be reflected in the master check. The master check is used to trigger messages combined with visual alerts using conditional formatting. As the master check is linked with all the other integrity checks present in the spreadsheet, the master check should show the error which has occurred inside the spreadsheet and in what area. This ensures a faster rectification process of the error. The more visible and immediate the alert, the better the response to rectify the same. Even after all checks are in place, one should always perform a visual or manual check for selected critical points. This is done to ensure that high-risk items are accurate and the spreadsheet is free from errors. In the modeling world, it is thus a very common thing to say test, test and test whenever possible. Finally, we have reached the final rule of making a model good, consistent and effective. That's simplicity. In general, simplicity refers to the quality or condition of being easy to understand or do. Same is the case for simplicity in spreadsheets. The simpler a spreadsheet is, easier it is for the user to comprehend it. Now one needs to be smart enough to achieve simplicity in a spreadsheet, because too much simplicity will only make the process less time efficient. A good spreadsheet model should allow an unfamiliar reader to follow the calculation without the need to trace formulae in order to understand it. This means that while you're creating a spreadsheet, in the back of your mind, you know what part or what cell of the spreadsheet is located where and why, and which location is linked forward. However, a new person using a model is bound to face certain difficulties. These include the basis for some assumptions being unknown, and they would generally find it difficult to understand all those assumptions and ultimately will be unable to use the model efficiently. One should follow the concept of KISS in modeling, which stands for the well-known, if somewhat rude, saying keep it simple, stupid. When in doubt, make things less complex rather than more complex. However, it does not mean that a model should be simplistic. It just means that for whatever your model needs to do, the best approach is always the simplest one. Moving on, let's try to understand the underlying principles of simplicity. First, keep it simple but not too simple. Like we discussed earlier, the spreadsheet should not be too simple, as it will only increase the building time and the length of the spreadsheet. Also, one should not lose the flow while keeping the goal to make the spreadsheet simple. The goal of the spreadsheet should be to make it easy enough to make it understandable to a pair of fresh eyes and fulfilling the purpose it is being created for. Sometimes, analysts, while creating a spreadsheet, try to make it simpler, for which they start mentioning each and every detail instead of linking them, which only increases their work and also makes the model needlessly bulky. Breaking down complex calculations is an essential element of effective models. Use a modular approach to break down complex calculations into understandable steps. Let us consider an example. While calculating the cost of raw materials, one can either directly link all the inputs for the same in a single cell, or the calculation can be broken into steps like the cost of raw materials per unit, quantity of raw materials used, and then going for the required calculation. Also, in some cases, if there is a nested if function, One should try to avoid using the same and replace it with other simpler calculations even though it leads to an extra row. What is a nested if function? A nested if function is a function which has more than 2-3 if functions inside an if function. This is done in cases where there are more than one conditions present. Nested if functions should be avoided as much as possible in a spreadsheet because they increase complexity and also the bulkiness of the model. Instead, they should be replaced by other functions which fulfill the same purpose in a comparatively simpler manner. Moving along, do not use methods that clients may not understand. There might be times when you realize that the method used by you is more efficient and reduces the time to solve a complex formula. It may be true that you're correct in the process, but if that formula is unknown to the client, he may face a hard time in understanding your solution and might even come across an error while doing so. Therefore, the method which was supposed to reduce time and increase efficiency ultimately results in increasing time and reducing efficiency. Also, you should avoid using uncommon functions. Keeping things simple also means you do not use VBA for calculations that can be done in the spreadsheet environment. VBA basically refers to Visual Basic for applications. Macros are a type of VBAs. Macros make the work very condensed and easy. But for a client unaware of macros and unable to use them, the work done is of a very complex nature. Therefore, until and unless there is a dire need of them like breaking a circular loop, macros should be avoided as much as possible. If a formula gets too long, consider breaking it up into 2 or more cells. You can also avoid using complex formulae entirely wherever possible. Another option is to break down complex formulae into its components. If a formula gets too long, one should consider breaking it up into 2 or more cells. Generally, there's a rule of thumb which says if you as the developer of a spreadsheet start getting confused when analyzing the formula, then it's too long and needs to be divided in parts. Secondly, complex formulas are difficult to check, especially if there are multiple if statements within them. These formulas should be avoided. As we discussed before, nested if functions are difficult to examine and makes the model bulky. These should be replaced with other functions which perform the same function but in a simpler manner. Thirdly, if a long formula is unavoidable, separate the components. In some cases, the formula written cannot be broken down into pieces or any other formula cannot be used instead of this. In those cases, the components of the formula should be separated and it should be made understandable for the reader. We'll see how this works in an Excel example. So here we have inputs which give us a percentage revenue share between various values of revenue. So for revenues between 0 to 25 crores, the revenue share is 0%. Between 25 to 50, it's 10%. 50 to 100, it's 20%. 100 to 250, 25%, and anything greater than 250 would attract a 30% revenue share. Now we have the revenues here. Let's assume that these are the inputs. Now there are various options to model the revenue share. In option 1, you see that there are a whole bunch of nested ifs and linking to all the inputs. So if someone were to sit and audit this formula, it's not clear at all whether the formula is linking the correct cells to the correct conditions. How do we break these nested ifs? Now in this case, you'll notice that every if checks for 2 conditions. That is, if the revenue is greater than the lower limit and if it is less than the upper limit. So it's greater than or equal to the lower limit or less than the upper limit. Now in option 2, this has been slightly simplified because in this case, every year's revenue or every period's revenue is only compared to the upper limit, because if it is less than 25, it attracts a 0% revenue share. If it's less than 50, it would attract a 10% automatically, because if this were less than 25, then it would fall into the earlier bracket and not move into this bracket at all. Now this formula is definitely simpler than the first option because there were so many nested ifs used here, and this has been reduced to 4 nested ifs. Now there is a still simpler option here which may not be available for you to code into a single cell, but is definitely most readable and understandable to the user, and that is by using various flags. So what is being done in this case is every single condition has been listed out, that is less than 25 crores, 25 to 50, 50 to 100, 100 to 150 and greater than or equal to 250 crores. And for each condition there is a flag that has been set up, which is if the revenue is less than, if the revenue is less than a certain number, in this case 25, then it should give you a flag. If not, it should be 0. So here you can clearly see in one glance for which periods the revenue falls into which revenue share categories. And then it's simply a matter of multiplying these flags by the percentage revenue share. To summarize, option 1 uses a bunch of nested if functions, and it's clear to see how complex this formula is. Option 2 uses a smaller function and lesser nested ifs, but these nested ifs can still be reduced. Option 3, the formula looks much simpler. The revenue share percent can be easily calculated using a sum product function, and this box is clearly understandable to anybody who wishes to even take a print and look at the model. So this would typically be the most preferred approach. And in this manner, you can always find a way to break down complex functions into smaller formulas. Even if it leads to larger number of rows, that's fine, because larger number of rows is better than various number of lines in the same formula. By now, I hope each one of you have understood how to break down formulas. Let's now have a look at some of the most common alternatives present to the so-called favorite functions. This section discusses the use of the choose function instead of nested ifs and use of index and match instead of the VLOOKUP or the HLOOKUP. The first function is the if function. The alternative suggested to if function is the choose function. The choose function returns a value from an array that corresponds to a supplied index number or a position. That is, the choose function returns the nth entry in a given list. Choose function is to allow activating one formula in a series of possible formulas without using nested ifs. The choose function works for up to 254 selections at a time. Now, to use the choose function, the syntax is choose the nth number that you want to choose from the array, followed by the individual item selections. Note that these must be entered as individual values or references to individual cells containing values. Moving on to the second most popular alternative, that is the combination of index and match instead of VLOOKUP or HLOOKUP. We generally advise against the use of VLOOKUP or HLOOKUP functions in a spreadsheet because these functions are not very flexible, making them error prone in case of any changes incorporated. Instead, one should consider the use of match function within an index function to give out the same output, which gives the required flexibility while calculating various scenarios. The Excel match function looks up a value in an array and returns the position of the value within the array. Because match can locate a row number based on matching it with the specific label or value, you can use the result of match as a row parameter and index. This combination is much simpler to use with increased flexibility in placing the lookup column against the items to be selected, as the index array range is a one column range. So we do not have to specify the column number argument. The user can specify that the function should only return a result if an exact match is found, or that the function should return the position of the closest match above or below if an exact match is not found.